welcome to our presentation on trade associations and their tax implications. Today, we'll explore key aspects like the definition of trade associations, determining their resident status, and how to handle business and investment income. We'll also look into donations, the deduction test, income tax exemptions, and tax administration requirements. By the end of this video, we'll gain a clear understanding of how trade associations manage their tax affairs and the compliance process they must follow. Let's dive in. A quick question. What is a trade association? So, a trade association is a group of individuals, partnerships, or a combination of both formed to protect or advance their business interests or professional development, can register under the Societies Act 1966 or the Companies Act 2016. Here are some examples of trade associations that are divided by two. First one is safeguarding and promoting business of its members. And the last one is developing and advancing the profession of its members.
A trade association is a resident in Malaysia if its management and control are exercised in Malaysia per Section 8(1)(c). Holding meetings abroad does not change residency unless decisions are made there.
Since we hold some of our meetings in Singapore, do we use our resident status in Malaysia?
I'm not sure. Should we check the rules?
I can help. Let me explain a bit about resident status. Our residency depends on where management and controls of our activities take place. As long as major decisions are made in Malaysia, we remain a resident trade association under Section 8(1)(c).
So, meeting abroad occasionally doesn't affect our status?
Exactly. It is all about where the core decisions are made.
First up, your revenue. Money from membership fees, entrance fees, and subscriptions. That is your gross income. Pretty simple, right?
Oops, not to forget that plant and machinery that is used in the operations of trade association are also eligible for capital allowance, and the income is not exempted.
Since 2003, remember to close those accounts by 31st December for the self-assessment system. Deadlines are friends, not foes. Well, got some business dealings with non-members, that income gets taxed separately, but the rules are the same as for members. Pretty easy, right? Got tools like printers, fans, or calculators for the association's work? Good news, because they are qualified for tax relief. Since 2020, small value items under 2,000 ringgit each up to a total of 20,000 ringgit get a 10% fast-track capital allowance. Any rental or interest income? Sorry, because that is not a business income. It is in a league of its own and taxed separately, source by source. And there you have it, a quick tax rundown about business and investment income.
Excuse me, I have a question for you. Yes. We earn from hall rentals and event fees. How should we classify this income for tax purposes?
Hall rentals are investment income, so it's taxable, while event fees are business income, which may also be taxable unless it is related to tax-exempt membership fees.
And what about our dividends from our investment?
Dividends are tax-exempt, but remember to separate expenses related to taxable and non-taxable income. Only those related to taxable income are deductible.
Oh, I see. Thank you for the clarification. See you next time.
Bye.
Got donation for something specific like building repairs or upgrades? Those are capital receipts, not taxable. The same goes for related expenses. They are capital disbursements. But if there's leftover money after finishing the job, it is treated as taxable income. General donation, like festive subscription from members, are taxable income. The good news, expenses for those events can be deducted. The deduction test under Section 53(2)(b) is straightforward. If the expense helps generate income, it is deductible because it directly supports revenue production.
We have received 50,000 ringgit for the renovation of our hall, but we also donated 10,000 ringgit to a local charity. Let's figure out how this impact our taxes.
Well, the 50,000 for renovation is capital receipt. If you don't use it fully, the excess will become taxable as revenue receipt. But what about the 10,000 donation for charity?
General donations are considered as income, so they are taxable. However, expenses related to generating income or hosting events can be deducted under the deduction test.
Alright, so we can deduct event-related expenses to reduce our tax liability?
Exactly. As long as the expenses are connected to the revenue account, they qualify under Section 53(2)(b).
Okay, I think that's all for this meeting. Bye!
Welcome to Association Bar. Let's break down the tax rules for Resident Trade Association. First, membership subscription are tax exempt under Income Tax Exemption number 19 Order 2005. Great news, right? But here's the catch. Entrance fees remain taxable. The taxman's rules leaves no room for exemptions there. Next, revenue expenses and capital allowances. These must be restricted based on the proportion of tax-exempt income, like membership fees, to your total gross income. Finally, if your association earns from multiple sources, such as seminars fees and subscription, it's related to one single business. All income is aggregated and taxed together. No splitting hairs here. So, keep your books clean, follow the rules and ensure transparency. With a little effort, Association Bar will continue to thrive. Thank you.
We're applying for tax exemption for promoting local crafts. I've collected membership subscription data and expense details.
Do we qualify for full tax exemption on all income? Not for you. Only membership subscription fees are tax exempt under the Income Tax Exemption number 19 Order 2005. Entrance fees and other income sources like seminar fees are taxable.
What about our expenses? Can we deduct them fully?
No, your common revenue expenses and capital allowance are restricted proportionally. For example, if membership subscriptions account for 60% of your income, only 16% of these expenses are deductible.
Understood? What calculation method should we use?
You can apply this formula. To calculate the revenue expenses, A times B divided by C. For the capital allowance, D times B divided by C, where A is your common revenue expense, D is your capital allowance, B is your gross membership subscription, C is your total gross business income.
Thank you. This helps us structure our finances and apply correctly.
Trade associations must file tax returns from TF by June 30 of the following year. Missing deadlines leads to penalties.
Did we submit our tax return?
Oh no! I thought you were handling it! Let's contact tax professional immediately. We can't afford penalties.
Don't worry, let's file it now. Going forward, set reminders to meet the deadline of 30th of June.
Non-compliance can lead to penalties and unnecessary stress.
So, to summarize, trade associations play a vital role in promoting their members' interests. Proper tax management involves understanding income classifications, applying for exemptions, and adhering to filing requirements. Always ensure compliance to avoid penalties. Thank you for watching, and remember, effective tax planning helps trade associations thrive while contributing to the economy. Let's make informed decisions together.